if you go out and you buy this home and you keep the numbers round and easy to understand, let's assume that this home costs $100,000. Now again, you're not buying this home to live in yourself, you're buying it as an investment property, so you're going to rent it out to somebody else. And let's assume that you can rent it out for $1,000 a month. So if you can rent it out for $1,000 a month, that's $12,000 a year in rental income, but you don't get to keep, I don't know what I'm doing here, you don't get to keep all $12,000. You have expenses to pay. So let's assume that a third of this money is going to expenses. This is your taxes, your insurance, your maintenance costs, your management fees. So that costs you 33%. So now you're going to send in about $4,000 a year in your expenses, which leaves you with $8,000 of profit. Now, if you go out and you get a mortgage to buy this property, that means you're going to have to finance $80,000. So you're going to have to pay some of this money back to the bank. So if you borrow $80,000, it's going to cost you something around $400 or so a month. So $400 or so a month is right around $5,000 a year, which means now you have to subtract your $5,000 a year in your debt costs, which leaves you with $3,000 in your pocket. Now, you're going to have to tell the IRS that, hey, I made $3,000 of income, and you're going to have to pay taxes on this $3,000 worth of profit. Except you get another tax break as a real estate investor. You get to tell the IRS that, hey, my property is a little bit older, and because my property is a little bit older, I deserve a tax break even if the value of your property is going up. So now you will get to tell the IRS in this case that because your property is older, you should get a $3,600 tax deduction. This is only on your taxes, which means that in your tax return, you get to tell the IRS that you made a whole negative $600. So you tell the IRS that you made negative $600 when in actuality, you put $3,000 in your pocket. The technical reason why you get to do that is you get to deduct one for 27.5 years. The reason being because your home goes through wear and tear, and you get to deduct that on your taxes, and you get to deduct this even if the value of your property is going up. So now you made $3,000. Your bank account has $3,000, but you get to deduct this much of your property every single year. In this case, that's $3,600, assuming that $100,000 is just the property. There's no land included because you can't deduct the value of your land. So now you are left on taxes on paper with a negative $600 income. You pay taxes on negative $600, which means your tax bill is zero. And the next time you have to pay taxes, you'll be able to deduct this $600 of loss against that. But you show the IRS that you didn't make any money, but in actuality, you still have money in your pocket and it's completely legal. This depreciation loophole is what allows people like Donald Trump to make a lot of money every single year from the real estate properties, but pay nothing in taxes because you get to deduct the value of depreciation of the property while you're still earning money. And then if the value of your property goes up to $200,000, what you could do is you can just refinance out. So now you can pull out another $100,000 and now you get this money in your pocket again, tax-free. Remember we talked about earlier, living off of debt? That's again what real estate investors do. When the value of the property goes up, they borrow against it, and now you have cash in your pocket tax-free. You can use this cash in your bank to go out and buy another property, create more income, get more tax deductions, and have more money in your pocket while you're paying less money in taxes. Legally. This, as you can see, is why financial education is so important. The average person is not going to be able to take advantage of any of these tax breaks because they don't understand how money works. And if you're thinking, well, what am I supposed to do? All I do is work a job. I don't have the ability to go out and buy some real estate as an investment. I don't have the ability to go out and start a business. Well, what you can do is first get financially educated. That way you can start moving towards the right direction. You don't have to go out and start a business to start getting these tax breaks. You can start a side hustle, which doesn't have to be a ton of work or a ton of time, but it's something that you can start doing, something that you can start implementing to earn some more money and capitalize on some of these tax breaks. And if you want to invest in real estate, it's something that you can do, but you first have to set your mind to it. I mean, if you put a little bit of money aside every single month, you will be able to work towards buying your first rental property. And if you're thinking that you'll never be able to afford a property in your area, well, then you can look in places like the Midwest, because in the Midwest, you can find properties for around $100,000 that will produce great cash flow, but you have to understand the neighborhoods. It takes time, it takes effort, but this is why financial education is so important, because anybody can do it when you have the right mindset and you have the hustle, but you need to know what to do. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.